Hi, I'm Sheldon Harbour, President of Asset Strategies, and today we have the pleasure of speaking with Bob Worthington of Hatteras Mutual Funds based in Raleigh, North Carolina. Bob, what we want to talk about today are managed futures. Many investors really, they've heard that term perhaps, but what is, in your mind, a managed future?
Managed futures is just essentially a portfolio where the manager is utilizing futures contracts. And futures contracts can be on a plethora of different strategies, whether it's treasuries, it's interest rates, it's equities, it's commodities, those types of things, and they can go long or short those particular futures. And they're trying to create a basket portfolio so that they can leverage off of trends that are going on in the marketplace to produce returns that typically don't correlate or move in tandem with equity or fixed income markets.
So when you say long or short, for the uninformed investor, what does that really mean?
Sure. Long is a traditional type of purchase, for example. So in this case, if you're going long a future, you're making a purchase, and think of it as a call option. So you're either buying a stock, it's akin to buying a stock and owning that stock. In this case, you're going long the future. So you own that position, and if it goes up, you're going to benefit from that. By going short, meaning that you've sold that position to someone else, knowing that you're going to buy it back at a certain price or buy it back in the future at whatever price it might be. And therefore, you're going to benefit if the price of that future or that security decreases. So you're hedging your portfolio a little bit to hopefully reduce volatility associated with those different instruments.
You mentioned commodities. I know oftentimes when I use that word with my clients, the red flag goes up and they start thinking about very high risk pork bellies, and there's a number of different types of commodities. What are some examples? Well,
again, it's anything that you think about. Soft and hard commodities could be anything like metals. Mm-hmm. So it's copper, tin, palladium, platinum. It can be soft commodities, so you're talking about corn, you're talking about milk, you're talking about wheat, soybeans, those types of things. So the experts there, typically not all of them, but many of them came out of either the Chicago Board of Trade, the Chicago Mercantile Exchange, where those instruments are traded, and the historical perspective of those respective exchanges. And so there they have expertise in looking for trends that go on in the wheat area, in the corn area, or they've developed these mathematical models that spot trends in different types of commodities, or again, equity futures or fixed income futures. And then they will take positions based upon what their models say.
When people think about risk in their portfolio, I think another misconception is that, well, if the stock market's bad, then the futures are going to be bad. How do you see futures fitting into a portfolio and correlating with the stock market?
Well, I would argue, and the data backs this up, is actually managed futures is probably the best, what's called non-correlating asset class that there is, even better than long-short equity hedge funds or long-short equity debt funds, excuse me. So managed futures historically has had either a very low or a negative correlation to equity prices. And a good example of that would be 2008, which everyone remembers for some bad reasons, right? That's when, especially later in the year, the equity markets completely tanked. But if you look at the returns of managed futures managers in 2008, they were actually positive. So again, that correlation was negative, meaning equities are down, managed futures were up. Now in 2009, when you had a strong rebound in the equity markets, actually managed futures kind of struggled. But that was okay if you had managed futures in your portfolio in both of those years. You actually had a much lower volatility of your returns, and you balanced it out and you kind of smoothed out the returns. That is why many smart investors and advisors such as yourself use managed futures to balance out exposure to equity or fixed income exposures.
In the past, I suppose the way that investors got involved in managed futures were they had to have a large amount of money invested and it wasn't liquid. It seems like things have really changed lately.
They have changed, and they've changed across the whole spectrum of what's known as alternative investments. So within the managed future space, yes, now where it used to be you had to have $250,000, $500,000, $1 million to invest directly with a managed futures manager. Now you can do it today through a mutual fund, and therefore the minimums are quite low. And you can invest in a mutual fund that does where you have a single manager managing that portfolio, but you can also invest in a mutual fund where you have a number of different managed futures managers put together in the portfolio, which again even balances out and maybe compresses volatility even more. So the good news on that is investors and advisors like you that advise to investors have a broader set of choices available, and you don't need a lot of money to get exposure to the space.
I suppose there's a difference in cost structure. I used to hear about, well, the manager got a certain percentage and then they got bonused, and you know, when you looked at all that and added it up, it seemed for most people too expensive. Mm-hmm. Has that changed?
A little bit, and I'll take you through that. First, I would always say when you're looking at any investment vehicle, whether it's a passive index on the equity side, a fixed income manager, an equity manager, a hedge fund manager, a hedge fund mutual fund, you always should look at netted fees. And if you know, I think the whole alternative universe has proved themselves, while fees have been higher, they've added value in a number of different ways because of their expertise. Now in managed futures, for the most part, even in the mutual funds, I would say that you still have expenses that are pretty high. For example, if you're utilizing most managed futures fund to funds, meaning they'll take it and they'll spread the risk across 5 or 6 different managed futures managers, are still done so in the format so you're paying you know, the higher fees that have been associated with managed futures. However, there are a couple funds out there now where actually you're investing with managed futures not in what's known as their partnership that can charge that fee plus profit, but a couple, very few, but a couple mutual funds are out there where you are investing with the managed futures manager in a separate account. And therefore the fees being paid to that managed futures managers in a separate account are much lower, because under mutual fund rules they can't charge that profit or incentive fee. So fees are starting to come down in the managed futures area, which again I think is a benefit for investors.
Well, Bob, we thank you very much for your time today and your great education. And if you have any additional questions, we'll have this video on our website, and we will look forward to any questions that you might have about investing in managed futures.
Investors should carefully consider the investment objectives, risks, fees, and expenses before investing. For this and other important information, please obtain the investment company fund prospectus and disclosure documents from your rep advisor. Read this information carefully before investing.